I would say that I would hope that there's an option that's making a responsible loan.
Mr. Gutierrez, the floor is yours.
Thank you, Mr. Chairman, members of the committee. It's great to be here. My name is James Gutierrez. I'm the CEO of Insect. I know it looks like insect, but it's pronounced Insect. We are a pilot program lender. I've been in this space as a social entrepreneur for about 10 years, very focused on how to provide high-quality credit to low-income people. It hurts me when I find people don't have credit scores in this country. It's like not having a face. And if you have credit that's been destroyed, it's very hard to rebuild credit unless someone's willing to give you a loan and report it. And if you can't rebuild your credit, you can't really buy a home. You can't start a business and get a small business loan. And so it's really hard to kind of see financial empowerment in our communities without starting with a basic loan. So I believe in this, believe in access to capital. 10 plus years ago, I founded Opportune that Raul spoke about. We still call it Progresso. We focus on the Latino market, as you know. Now I'm running Insect, started that 3 years ago. We really believe that this problem of solving, this small dollar loan and giving people high quality credit is universal. So we're reaching into all communities of color, not just Latino market, all everyday Americans, trying to help them. And we have a new model with Insect that's kind of a high-tech, high-touch. What we do is we say, well, look, there's some lower-income people who really believe in and know Maria, who works down the street at a money transfer location, or maybe there's a credit union or a bank, and they trust them. Getting a loan is kind of very complicated at times, so I go to someone I trust. Well, how can we equip Maria with the technology and the underwriting and the risks so that she can be able to offer that loan? So we actually formally participate in the pilot program, but as a finder, and we're one of the few to use the finder regulation, the pilot program, to expand access. On the regulatory front, we were active in 2010, along with Senator Flores, in kind of founding the pilot program with the original bill, participated in the subsequent bill that increased the rates on the original pilot program. And then more recently, we sponsored SB 235 that expanded the finder regulation so that we can, expand access across many, many locations in California, as opposed to just like we did at Progresso, which is focusing on our own stores. So that's a little bit about my background. I was also on the member of the Sabrifa panel that overviewed the CFPP rules, so very familiar with those as well. I just wanted to mention 3 topics today. I know our time is limited. The first is a little bit about the market, and the second and third are kind of what we think good policy would be. I'm going to say those outright because I know our time is limited. The first point is that standards should be universal. So standards shouldn't just apply to loans below $2,500. It should be all loans. There's some great standards in the pilot program that we think should be accelerated and moved to all loans in California. So we support comprehensive reform. I think it's a great idea. The California law has been around for a long time and needs reform. We also support the pilot program. We believe that the pilot program should be expanded through this comprehensive reform initiative. And then finally, we encourage that any policy should encourage technology and innovation. And so let me just touch on that.
About 1 minute, James.
Briefly. Okay, last minute. So 2008, big crisis. What happened after that? There's a lot of credit that was removed from the market. I think Paul mentioned earlier, hey, let's just get a credit card. 122 billion of credit cards targeting the non-prime population. And we saw from the committee report, 55% of Californians have a FICO score below 700. So for those people, 122 billion came out from 2009 to 2012. So where do they go? What's happened since then? 3 things. First, marketplace lending has taken off. This is the peer-to-peer lending. This is not under the purview of California because all marketplace lenders use federally chartered banks to make their loans. So banks out of Utah, et cetera, other states. And so you don't really have the data. It's not directly regulated by the state. And so what's happened there, though, is there's been about, the 2 largest lenders, about $9 billion of loans this year alone, 600,000 loans made, but they're largely to prime people, not to non-prime. So in the non-prime segment, we've seen an explosion of installment loans. And I think what you're seeing there is that consumer reaction is that installments are easier to understand. They're better than credit cards. They help you budget. So there's been a strong preference for installments. You've also seen a huge increase in online payday lending. And in California specifically, there's been an increase in loans above $2,500. And I would say that's probably because there's no cap on rates, and it's a very open environment, let's say. And so if you're deciding as an entrepreneur, where do I operate, it's a lot easier to operate in California above $2,500. And then if you want to be national, you partner with a bank, and then you have licenses in all 50 states. And so that's what we've seen from an entrepreneurial perspective. I think what we want out of good policy is how do you get innovators to want to be licensed under California instead of going in through other avenues, and that should be a goal of comprehensive reform. So last 10 seconds here. So on standards, we believe you shouldn't make a loan that people can't afford, so ability to repay is very important. That should apply to all loans, credit reporting. Also, the pilot program does a good job of setting standards on how to do refinancing of loans. We believe refinancing done the right way is good for the consumer, and that should apply to all loans, including loans above $2,500. Lastly, on encouraging technology, one example, SB 235, you have this partnership with Maria who's there in front of the customer, and you have technology coming together. Good policy will create more examples of those kind of partnerships so that if you have a good loan, it can actually get out to everyone who needs it. Thank you very much for your time.
Since we have James here really quickly, and then we'll go to Cillian Regato if he has a follow-up too. Since you're kind of the father of this disruptive technology that has taken off in this marketplace, two quick things. What should good underwriting look like? Secondly, Mr. Vasquez, you could answer this as well. Available data suggests that 40% of installment loans end up going default status. I don't want to make you release private data from your company, and James, same to you. What are your default rates that you can share with us, and what are some of the challenges you face with these installment loans that are obviously at a longer rate or a longer period to pay off and a lower rate that you face with default?
So, sure. I'll start with the last question and then the first question. Well, underwriting standards. So underwriting standards, ability to repay that the CFPB's come out with, we think is great. I think it's what I argued at the Sabrifa panel to the CFPB in D.C. was that they should take the pilot program rules because we actually think those are better. The one thing, the deficiency in the CFPB rules is that they want to prove expenses, and that doesn't work because most of the people, share homes, have, not everyone has a formal rental agreement. It's very hard to verify any expenses except those that exist in a credit bureau. So we're fine with expenses in a credit bureau, but anything else is unverified, should just be self-reported. Verified income makes a lot of sense. So a lot of what's already in the pilot program, and I think merges to what the CFPB is saying, and we support. On the second question of losses, I've testified in this committee before, dating back to when I was running Progresso, and I said kind of the story of Progresso is that, we started with the goal when I built it to, start with 10% loss rate, and we were hitting that, and then the crisis hit, and unlike, credit card lenders in the prime segment that saw losses go up like 300% in the crisis, we were very happy that our losses only went up by 25%. So that's kind of counterintuitive to what most people would think. It just says that people that are in the non-prime segment are kind of always in a crisis and therefore manage very well, whether it's a crisis or not. What we found is after that, we're able to get that into the single-digit rates. As a current company, our goal is to kind of hit a similar trajectory as what we saw and what we did all those years through the financial crisis before.
And I'm sure most of your defaults are both of you. There's a certain amount of payments that are made. Very few are probably completely a loss where they don't make any payments.
Where they don't make any payments, there are very, very few. So that we would consider fraud. And certainly what we do is every year we invest more in the risk engine. The risk engine, I think, is a critical element of the question that you've been asking of what's more important, ability to pay or price. And I think we would agree with Mr. Leonard's statement that both are important. Yeah. I think the benefit of really having a great ability to pay standard is that it can drive then the term of the loan. It can help drive the pricing of the loan. It can get to the rates that you were looking for, which we do offer rates below 36%. And that ability to repay becomes a critical element of having single-digit default rates, which is what we have. It is what we target, and every single year we invest more and more to optimize the engine to continue to grow the business while still having single-digit default rates.
Mr. Gatto, would you like to?
So forgive me for missing part of this hearing. I was chairing another committee hearing down the hall, but I asked an earlier witness what are some of the default rates in this industry as a whole, and I'm just curious if anybody wants to chime in with some ballpark figures. Yeah, well, Mr. Leonard.
I don't mean to take time, but I mean we first of all the DBO under the CFL. They collect and report for individual lenders default rates that are important, but if not somewhat imperfect. That is, they are not a measure of a cohort of loans default rates over time. They report the amount, the number and percentage of loans that go into default in a calendar year without any reference to when those loans were originated. The default rates are all over the map. We reported on those. I just sent around our paper on the installment lending, which have some of the data on default rates. Cash call, you'll hear from later from a representative in the cash call was a traditional 2,500 and above lender. Overall default rates of 35 to 50%. It depends on what your denominator is on these default rates, but check and go, Rise lending, both have default rates based on if the denominator is the number of loans originated in 2014. They have default rates of 18 to 20%. I believe it's in my paper.
And if I can add to that,
go ahead.
There's one other element that hasn't been discussed yet, which is the approval rate. One of the areas where
I didn't ask about approval rate, so maybe we could go through my comments first.
Sure.
So I guess the other question is, none of these lenders we're talking about today are traditional banking institutions. I know some of the banks are offering products like this, but do you guys have access to the Fed discount window? So you have a cost to capital as well.
No, we don't.
Who are your typical providers of capital? I'm curious. Hedge funds?
So this used to be my biggest argument before when we were building my old company, was access to capital was hard, and we were borrowing hedge funds 15%. Now it's a combination, still borrowing from hedge funds, frankly. And then once you have enough history, and really it's just, and we had data through the crisis, which was very helpful, but still people were uncomfortable. What's happened since 2012 is that the credit markets have come back in a major way, and so now we actually surprisingly
junk bonds at 6%. Yeah.
Well, it's surprising is we're a new company with less credit, with history of loan making, whereas before we had all this years, and we can now get bank lines when before that was not on the table. So I would say that let's just say this: in the worst of times when credit's difficult, one example is probably borrowing at 15 to 18%. Credit's very tight. You can securitize. You can do a lot of things, and you have access to 3 to 5% money. Again, depending on the strength of your underwriting. I do want to mention one thing about loss rates before. Just think about loss rates in two markets: prime and non-prime. So in the non-prime space, typically in good times, 15 to 22% is probably loss rates on credit cards, non-prime. In the crisis in 2008, when that happened, the top three non-prime players, they saw their losses go from up to 25 to 45% loss rates. So it can go up to 45, and then in steady states 15 to 22 is sort of the range. And so that's kind of how you should think about it. In the prime space, credit cards typically are 3 to 5%. And then when things go bad, they went up to 12% in the crisis.
So what I'm trying to wrap my head around is, I did some back of the napkin or back of the agenda calculations here, and if you have a 10% default rate, well, actually, how about this? If you have a 20% default rate, that would require the non-defaulting borrowers to pay 38% interest for the company to earn a 10% interest rate. And if you figure that you're borrowing that money then from hedge funds at 15%, which is higher than I thought it was, I had figured that they could get it for something around LIBOR, but apparently not. You figure in overhead and everything like that, and that is the crux of these interest rates that everybody always hears about. Of course, if you build in a higher default rate, plus a higher cost of funds, then the interest rate has to be correspondingly higher to cover costs to provide this product. And so I keep coming back to the question, which is what should we, and by we I mean society, what should we do about people who, a cohort of borrowers who need money, they need capital. In our world, credit is money. An economist just said that, and far smarter than I am. And what do we do for people? Because the answer can't be, well, we just don't give them loans ever. But then if we service them, and then you've got these built-in rates that, interest rates are like the most market-driven force in a world that is forgotten in many ways that there is a market. I mean, I just don't see the answer to this, and I'd love to hear folks weigh in briefly.
Sure. I feel like it's a good question, and certainly I agree with all your points earlier about the need for credit. From our perspective, what ideally would happen is the market would separate into more distinct slices than simply prime, super prime, subprime, and people without credit. And you could have much better.
That seems to imply that there's different underwriting criteria that aren't currently allowed. Like looking at someone's Facebook page and looking at someone's. I'm serious. I mean,
well, it doesn't necessarily have to be that, but you're right. And the reason I was bringing up approval rate earlier is approval rate has a strong connection to default rates, which is part of what you were asking.
But
about.
if you lower the approval rate, you basically are saying less people get credit.
Not necessarily, because what will happen is if you have solutions that evolve at every point in the spectrum, but then you have to be able to allow pricing for that particular segment. You could have good underwriting. You could measure it based on what defaults are at that price, because there's not only the cost of interest that you mentioned, there's the cost to acquire, there's the cost of the service, and then there's your G&A. Right. So I think one of the challenges with some of the solutions is they are so broad, right, that you are letting in people that aren't going to pay you back, and then your good customers are basically subsidizing those bad loans. So where I think we have...
So you're arguing for different tiers, for allowing for much broader authority to lend to different.
I would start first by saying one of the areas where we absolutely agree with the advocates is a loan is not the solution to every problem. Right? In particular, as you consider reporting to the credit bureaus, if you report a default, that is going to hurt someone's ability to get a job, someone's ability to get an apartment, someone's ability to get low price credit going forward, right? But if you allow price plus the right underwriting standards and other consumer protections that exist to float a bit, not egregiously, again, another area where
that contrasts with something that you said, though, because if you do not allow people to appoint, if you don't allow these companies to report a default, then how do they distinguish between the good borrowers who are subsidizing, as in your terms, the
you
poor?
You have to report a default.
Yeah, I think you have to report the default. There have to be consequences for not paying back. But if you had solutions evolve for a particular part of the credit spectrum with the right terms, the right pricing, the right protections, then we can take care of the person that needs to provide for her children. You can take care of the person. But to think that
seems to argue in favor of deregulation, just lessening the strictures and allowing the market forces to put them in, because if there would
not make that argument, because I think you all play a very important role in providing guardrails for protection, and I think the pilot's been a great example of that. The question is, how does the pilot evolve, and then is there something like that maybe for another part of the spectrum? Could you all put something else together like that requires partnership of advocates and industry players to have something that is well thought out and that is careful, and that you get to see how it evolves?
Amount for how
Our
long?
average loan amount
and duration of time.
For a new customer today, our average loan amount is $1,200 to $1,300, and it'll have a term of about 12 or 13 months.
What do they pay on that loan? So they got $1,200. What is their in?
So I'll tell you averages instead, because that'll be
fine.
Okay. Our average APR across all of our loans is 38%.
So they're paying $1,500 on a $1,200 loan, roughly.
Roughly, that's right, roughly. And one of the things that I think CRL has noted in our report is as a customer deals with us more, we lower their rate and we give them access to more capital. So one of the things that we've been able to do is beyond $2,500, where there's no limit whatsoever, we offer our lowest rates, because we think that that is a key element of showing a customer the benefit of responsible borrowing. Happy to talk to you more about it, but I do think it's almost point solutions for different consumers. I'm sorry, Paul, you wanted to...
Before we do that, Paul, can we just say, in the essence of time, I will ask Raul and Mr. Vasquez and Ms. Gonzalez if they could step down, and we're going to let two more speakers come up. But I do thank you for your testimony today. We look forward to working with both of you in the near future. And before Paul, we'll let you give a moment to give a quick brief remark on that. Can we ask Ms. Fern, attorney for Public Law Center of Orange County, to come up, and Lester Furstenberg, Global Regulatory and Government Affairs Director for DCF Global Corp. If you guys could come up, and then after that, we'll go.
Two quick points. First of all, I wanted to reiterate the last point that was made, because Progreso Financiero, or Opportune, is now the largest lender in the above $2,500 space, and their APRs on all of their loans, they made 82,000 loans between $2,500 and $5,000, and their APR on those loans, almost all of them are below 40% APR.
But as a percentage of the market, they're such a small percentage of the market that you've got to conclude that yes, okay, so if they have stricter underwriting, that stricter underwriting is just another word for some people don't get loans. And
well, no, but many of the others are going to, some of the others who are, Check and Go is the second largest lender above $2,500, no interest rate regulation, and their APRs on their typical loan is 219%. What that means is you repay $7,600 on a $3,000 loan over 12 months. I would consider that to be an excessive amount of payment. And Check and Go has a 20% default rate. And so one of the things that's also the second point I wanted to make is that not every loan that defaults on a high-cost installment loan is necessarily losing money for the lender. Because on a Check and Go loan, for example, if they're making a $300 payment over 26 payments over a 12-month period, they're getting back their full principal after a fraction of the number of payments that are loaned. So even loans that default may in fact be profitable even before they write them off on their taxes.
Sure, and this was a back-of-the-napkin calculation, but I mean, it's really not that hard to get to a very, very high interest rate. I mean, it just blew me away when I was sitting here in the earlier part of the hearing and calculating that approximately if two borrowers default out of 10, you're talking you need a 38% interest rate, 40-something% interest rate, based on what I heard about the cost of borrowing money just to break even. I mean, it's to service this market, it seems like there are some inherent challenges, and that's to say the least.
Well, sure, and fundamentally, it's a question about where and how you draw lines as a matter of public policy and protecting consumers.
We're going to give Mr. Gutierrez 30 seconds before we go to Mr. Goodall.
I want to make one clear point. We do not believe in restricting access at all. So, standards make sense. So standards like making sure people can afford the loan, that's a way of protecting who kind of gets in, but we should not decrease access at all. The communities need access. Here's the other challenge I think that you face is maybe let's say we only approve 40%. Where do the other 60% go? They still need, there's a boot on their car. What do they do with that? Where do they go? That is still a challenge. We just believe that standards should apply across the board, but that we're still faced with that challenge. And making money on small loans, as you mentioned, the one cost that you should also add to that is when I founded Progresso, and our cost to acquire was like $500 per customer because we didn't have the advantage of scale. And so if you think we lend $1,000, get back $1,200, you're already underwater. Forget about your cost of borrowing. The cost to acquire is exceedingly high. Thank you.
Okay. Thank you, Mr. Gatto, for that. Would you like to, anyone? Okay. Mr. Gonalti, would you like to take your...
Yes, thank you, Mr. Chair. And members of the committee, I'm Dan Gwaltney, President of the California Financial Service Providers. Our trade association members offer a myriad of products from check cashing to deferred deposit loans, installment loans, pawn, money, wire transfers, just to name a few. Our customers rely on these services to meet the needs of their financial obligations when financial institutions that they normally do business with cannot meet them. We are grateful to the committee for giving us the opportunity to be here today. Year after year, the discussion surrounding this topic seems to focus on how the single payment payday loan product may not be properly satisfying the credit needs of those that seek it out. As pointed out today, the Consumer Financial Protection Bureau's proposed rules will more than likely attempt to impose a nationwide one-size-fits-all structure that will, by its own admission, lead to severe reduction in credit availability to those Americans that need it most when their credit unions and banks will not provide the small dollar loans that they need. Unfortunately for us in this state, alternatives are vastly limited, as the committee has pointed out, that under 2,500, it's just been dysfunctional for years. We've been at various committees year after year, and we keep seeing the same thing, that many have called this the 500 to 2,500 is pretty much the wasteland of California lending because there's very few money being lent in the space. This is borne out by the comparison that was made earlier that in the deferred deposit loan area, it's 12.4 million transactions a year, whereas an anemic 346,000 unsecured CFL loans are done under 2,500 in 2014. Or we can say it another way. By the end of the day today, January 11th, more payday loans will have been funded than all CFL loans all year long. This disparity is a direct mismatch between the CFL loan provisions and the costs incurred by lenders to affordably satisfy customers' demands. Given the incremental expenses of labor, underwriting, servicing, charge-offs, as mentioned before, and the cost of funds, our members cannot structure a commercially viable loan within the confines of the current CFL loan. As a result, customers that come in seeking $1,000 they must choose between two different products that aren't designed for that particular purpose. They have to either cobble together multiple payday loans, which is high cost, or they have to jump up to a loan in size that is greater than the need that they're looking for. Simply, unfortunately, we see a lot of customers then just turning to readily available, right-sized loans on the unregulated market. You can find them easily online. The second round of pilot program attempt has tried to meet this demand, as we heard earlier today, that it is working for certain lenders. Under the pilot program, I believe there's only 3 companies that are actively lending. We hear from 2 of them. And the figures that we've heard, the volume, and it's been over the course of 3 to 4 years. And we think that there is promise there, but it's just not satisfying the market as a whole. We even have some members, though, that are partnering with, like James's company, to attempt to offer these loans through our service centers. But we're nervous to see what happens when the CFPB puts in new rules, that if our lenders, our members cannot continue to do business, these finders are going to go away. And then how are these companies being able to offer these loans when they have to take on the cost of offering them through their own physical locations, per se, where the costs are greater? Looking at the pilot program, there are certain things we like about it that we can build on, but when asked, hey, why don't some of your lenders become lenders in the pilot program, we've heard some of the companies testify in the past that they've had to go at least 5 years before making a profit. And that due to the default rates and as stated earlier, the high cost of acquisition of the customers initially, and then dialing in the secret sauce, you go years and years without being able to do this profitably. And that doesn't inspire a lot of investment. We are worried about the downward effects that would occur on profitability in this low interest rate environment when we hear that the Fed is looking to increase interest rates. So that is also a stumbling block to have new lenders come into the space. But we think that it's time I think the committee is doing the right thing by looking at this $500 to $2,500 space. And we agree with a lot of what's in the pilot program that we can take and expand on to offer more choices, not just in addition to the pilot, but we can expand into other products. We think a product should have simple interest, with no add-on, unsecured, fully amortized, no balloon payments, no prepayment penalties or credit insurance allowed, clearly worded pre-transaction disclosure notices, underwriting to the borrower's ability to repay, disclosures of finder's fees that can't be passed on to borrowers. We believe that you should report payment history to at least one nationwide credit reporting agency. There should be limitations on refinance. And we can look at reduced rates for people that show a past agreed performance on the loans. So in short, we think that there's opportunity here to expand the number of available credit products and not rely solely on ones that are in place today. Thank you.
Thank you very much. We will now turn to Sofia Garcia, State Director of Government Affairs for Advance America. And while we're doing that, if Jabo Covert, Government Affairs for Checking and Cash would also like to come up.
Good afternoon, Mr. Chairman and members of the committee. My name is Sofia Garcia, State Director of Government Affairs for Advance America. Advance America is a non-bank provider of consumer financial services, including payday loans. We have more than 260 locations here in California and employ more than 750 individuals. The need for short-term credit in California is real and remains at an all-time high. Consumers need legitimate, easy-to-access choices in short-term credit. Some recent studies explain why. According to a survey released last week by Bankrate.com, approximately 63% of Americans have no available savings for things like a medical emergency or critical car repair. And in the past year, 4 in 10 Americans experienced a major unexpected expense. Another survey by GoBankingRates.com found that 62% of Americans have less than $1,000 in savings. So where should consumers turn to handle an unexpected expense? Here in California, the only legal viable consumer option to borrow less than $2,500 is a payday loan. And that, as you know, has a legal maximum of $300, which is often not enough. So let me take a moment to explain what a payday loan is and how much it costs both customers and us as a lender. To get a payday loan, a customer needs 2 forms of ID, proof of income, and an open active checking account. The cost is a one-time flat fee with no compounding interest. The legal maximum is $17.50 per hundred, and the loan lasts until the next payday, usually 2 to 4 weeks when the borrower pays it off. That $17.50 fee enables lenders to cover rent, finance, labor, and insurance costs and earn a reasonable profit. Here's how the cost breaks out on average in our Advance America stores across the country. Nearly 61% pays for store costs such as rent, utilities, salaries, and benefits. Nearly 19% covers our loss rate for bad loans. A little more than 11% goes to corporate and other expenses, and just under 1% pays our costs for borrowing money. These costs amount to 92% of total revenue. Remember, these are national averages, and costs in California are usually higher. That leaves about 8% in profit. When you look at the small dollar short-term products offered by banks and credit unions, it is clear why payday loans make personal and financial sense for thousands of Californians. A payday loan is often the least expensive dollars and cents option when compared to the higher costs of bouncing a check, paying overdraft protection fees, or incurring late payment penalties. The FDIC studied bank overdraft programs and found the median fee for a $100 check overdraft was $41. A $100 payday loan has a fee of $17.50. So what's the better option? These are the real type of choices our customers make. While consumers look at payday loan costs in terms of actual dollars and cents, those who don't like payday loans often describe them in terms of APRs. Yes, the APRs are clearly disclosed in stores, but that is not an appropriate indicator of the real price of our product. An APR doesn't represent the actual cost of a 2 or 4 week loan. The APR represents the cost of taking out 26 consecutive 2-week loans for an entire year, with a customer paying a new fee every time. That is not how our customers use this product. If you rent a car for $100 a day, would you describe the rental rate as $36,500 per year? Probably not. Would you rent a hotel room at a rate of $73,000 per year? Well, that is $200 per night when calculated as an APR. The CFPB reports that an overdraft loan can have an APR as high as 17,000%. And the $21 fee charged by the state of California for paying a $121 DMV registration just 1 day late has an APR in the many thousands. You've heard suggestions that instead of the simple flat fee structure in California law today, payday loan APR should be capped at 36%. For a $100 loan lasting 2 weeks, a 36% APR results in about $1.38 in revenue. That's less than 10 cents per day. It is simply impossible to sustain a regulated small dollar short-term loan business with a 36% APR cap. A store couldn't even come close to covering the costs I mentioned earlier. Unworkable interest rate caps simply harm consumers. They eliminate legitimate options for thousands of people who need short-term credit. They can force them to choose costlier or unregulated alternatives. The reality is, eliminating legitimate options for short-term credit will not eliminate the demand. Consumer interests are not served by regulations, laws, or artificial barriers, such as a 36% APR cap, where business models can't be sustained and credit products aren't available in the marketplace. Consumers are best served when they have a range of choices that allow them to decide what is best for their individual situation. We look forward to working with the committee to find the best ways to ensure consumers' need for legitimate regulated credit are met. Thank you.